And before you get into anything today, I wanted to ask you something. What if someone walks up to you on the street and says, hey, I wanted to hand you over 20% of your business income? What would you say? You'd obviously say yes. You'll probably ask them where they have been all your life. Well, Congress just did exactly that. And most business owners have no clue about it because obviously they are working with the wrong people. But here it is. Hi, my name is Dhiren Girode. I'm a co-founder of D2 Tax, and I have been doing tax planning and accounting long enough to know that the topic that we are going to talk about today is going to be one of the most important deductions available to business owners that they are not claiming. It's called the QBI deduction, and we are going to do a deep dive into it today. Let's go. Question number 1. What's QBI deduction? Congress actually did something smart. I know it's shocking, but hear me out. When they rewrote the tax code back in 2017, they realized something. Big corporations were getting taxed just at 21%. But the guy running a landscaping company, a woman running a consulting business, and a plumber running 3 trucks, they were getting taxed at individual tax rate as high as 37%. And they realized that that may have not been fair to them. So they created the QBI deduction to level the playing field for the little guy. It basically says, if you are a pass-through business, meaning your business income flows through your personal tax return, you can deduct up to 20% of that qualified business income before we calculate what you owe. They wanted the small business owner to have a fighting chance against the big guys, and that was the intent. They said, well, we see you are a small business owner and we are going to give you a break. The question is whether you will actually take it. Question number 2, so who qualifies for this deduction? Well, this is where people get tipped off because they assume it is complicated. The baseline is actually pretty simple. If you're a sole proprietor, a LLC, S corporation, or a partnership, basically any business where the income passes through your personal return, you are in the conversation. For W-2 employees, sorry, not you, because you are working for somebody else's deduction. But here's the thing Congress was thinking when they wrote this law. They wanted to reward business owners who are actually running something. I'm talking creating risk, creating jobs, and building businesses. So they tied it to business income specifically, not investment income and not salary income from an S corporation, the actual qualified business income. And this distinction matters a lot more than most people realize. Question number 3, so how much money we are actually talking about? So let me make this real. If you got a business bringing in $200,000 in qualified business income, the deduction is potentially 20% of that. And that's $40,000 that you never get taxed on. Never. Gone from the taxable income. And depending on your tax bracket, it could mean anywhere between $8,000, $10,000, or $12,000 back in your pocket every single year. Now multiply that by years you did not knew about it and let that sink in. I have sat across business owners and done the math out loud and watched their face turn change. I've actually sat down with business owners and discussed this deduction and calculated it and watched them get really, really aggravated. And that is not a rounding error. That is a truck payment. That's a piece of equipment price. That is a hire that you can make in your business. Part-time, but you can make that. Congress knew what they were doing. They just wanted this money to stay in your business and that money goes right back into the economy and not go to Washington. Question number 4. So if Mike made $150,000 last year and never claimed it, what did Mike just do? Well, in plain words, Mike just overpaid. Mike handed the IRS money. He didn't have to. They never asked for it. And the frustrating part is the IRS is not going to call Mike and say, hey buddy, you left some money on the table. That is not how this works. The IRS is in the business of collecting. Their job is to simply enforce the rule that Congress made, but they are not in the business of making sure you use every rule available to you. That is your job. And more importantly, that's your tax professional's job. Mike actually needed someone in his corner who was paying attention. His finances. And the law was designed to help him. Mike just didn't know it existed. Why? Because the person Mike decided to do his taxes with was probably not the best person for his business. They probably did not update himself or herself about the changing landscape of the tax law. They probably did not understand how important it is for his or her client to have that valuable money with their own possession. How important it is for his or her client and what the value for that money is for their customer. If you try to cheap out on this, as you can see, it costs you quite a bit and that money usually never comes back. And if they can't go back and fix it, then we will. So at this time, if you go back and look into your tax return, if you're seeing those deductions are not available and you go back to that accountant and ask them to fix it, if they don't know about it, they're not sure about it, and if they start to give you mumbling answers, then you need to find a different accountant or call us and we will fix that for you. Imagine how much money you can get back if you had known this deduction was available to you. And I'm sure you can put this money to use better than any other government agency can do. And for sure, this money would have not funded the waste, fraud, and abuse that we have been figuring about these days. Less money for hospice fraudsters, less money for fake daycares, less money for the Leering Center, and less Medicaid fraud all day long. All right, that's just as far as how I will go politically, but you get the point. And this is exactly why I made this video, because there is a lot of mics out there, and I would rather they find out about this from me for free and take some action. And if nobody will help them, well, you know where to find us. Question number 5. Does your business structure matters? Well, if it matters more than almost anything else in a tax life. Here's the honest truth. True business owners can make the exact same kind of money but pay complete different amount of taxes legally just because of how their business is structured. Congress designed QBI specifically for pass-through entities only. So if you're still operating as a sole proprietor because that's just how you started and nobody else told you to revise it, you might be leaving deductions on the table that a different structure would unlock. I think about it like a flight plan. If you're trying to go from point A to point B, there are multiple ways to do that. But the right route you pick can determine how much fuel, time, and efficiency you can pick up along the way. Structure is your flight plan, and most people file it once at the beginning of their structure and then never look back. What kills this deduction? Well, bad books definitely kills it. If your income and expenses are mixed up, you can't actually calculate accurate business income. No numbers, no deductions. Mixed expense will definitely kill it. Personal stuff running through the business muddies the water much faster. And a wrong entity type can definitely wipe it out. And here's the most important one. Certain service business start to lose this deduction as their income starts to go up. Doctors, lawyers, financial advisors, consultants in some of the cases. Congress made a very deliberate choice there. They wanted the deduction to go to businesses that specifically produced goods and create jobs. And service businesses at a high income level, they drew the line. So depending on what you do and how much you make, the rule definitely changes, which is exactly why this is not a set it and forget it situation. Question number 7. So why making more money you lose that deduction? Let me explain that. I know how that sounds. You work hard, you grow your business, you cross a certain income threshold, and suddenly your deduction starts to shrink. If you make around $278,000 and if you're filing a tax return single, it phases out. And if you're filing married jointly, it phases out at $556,000, give or take. And it starts to phase out after that completely. And here's the intent though. Congress was trying to target the benefit to a small business owner who really needed the relief. The person who was grinding it every single day, not the person who can afford an army of lawyers. At high income levels, you got more options, more strategies, and more tools available. So they pull the deduction back gradually. Now, and this is the important part, this doesn't mean you just accept it and move on. There are legitimate strategies out there like retirement contributions, entity structure, income timing, they can keep you in the deduction range, but that requires proactiveness. You can only do that if you know these profitability numbers or your projected numbers ahead of time. You have to plan before December. You can figure these things out late in the year. There's no way, not at all. Question number 8. So if Tony files his tax returns late every single year, is that okay? Well, Tony is not okay. Tony thinks he's okay because he's eventually filing and paying what he owes. But here's what Tony does not see. Every time he files late, there is a penalty. Every underpayment is acquiring interest and it is compounding. Every late filing is a penalty. Every underpayment is an interest and it compounds. I've actually lived a version of that myself. My tax bill one year was almost zero, but the penalties and fines I paid because of the timing and execution issue, that number was real. 6 months after you file, a bill shows up and the money you would have used to pay it always gone. And 6 months later, a bill shows up and the money that you would need to pay that tax would have already been spent. You already spent it. And in this case, Tony isn't losing money to penalties. Tony is training himself to be reactive instead of being proactive. And being reactive is the most expensive way of running a business. Congress built the deadline into the tax code for a reason. They wanted a predictable collection. The penalty system they created isn't accidental. It is designed to get your attention. Question number 9, TurboTax guy. So if you're a TurboTax guy, you file the tax all by yourself. Are you getting this deduction? Maybe, sometimes. But here's my honest answer. Tax software is built to ask you questions and fill in the boxes. They are not designed to look at your full picture and it is not built to look at your whole situation and say, wait, have you thought about this? Have you considered this? And is your structure optimized for this deduction? Garbage in, garbage out. Software does exactly what you tell them. It doesn't push you back. It does not know that you bought a piece of equipment last month that changes your picture. It does not know you are approaching a threshold and then there is something you could still do about it. I'm not against technology, I use it myself. But there is a difference between filing a taxes and planning a taxes. TurboTax files the taxes, it doesn't plan. And QBI is a planning conversation and not a filing checkbox. Question number 10. Bonus depreciation just became permanent too. How do these two work together? This is where it gets genuinely exciting if you are a business owner who's buying equipment, vehicles, and machineries. Anything physical that your business uses, bonus depreciation lets you write off the full cost of the qualifying asset in just 1 year. Not over 5 years, not over 7 years, 1 year. Now here's how they work together. When you take a bonus depreciation, it reduces the taxable income, which also reduces your QBI. So you want to be strategic about sequencing this. It's not always take everything you can write off. Sometimes the smarter move is to time it. So both the deductions are working in your favor across the right tax year. I think about it like two engines on a plane. Both are powerful, but you manage them together, not independently, right? And the coordination of these two is where the real tax strategy lives. Question number 11. If Sarah has been a sole proprietor for 6 years, what did she miss? Well, possibly a lot. As a sole proprietor, Sarah technically can access QBI, but sole proprietor also means she's paying self-employment tax on everything. So no salary structure and no strategic separation of income. And depending on what she's earning as S corporation election might dramatically change her overall tax picture, including how a QBI interacts with her income. Congress gave pass-through entities the deduction, but they don't tell Sarah which pass-through structure was optimized for her situation. That's not their job. The law creates the opportunity. Your structure determines how much of that actually applies to you. Sarah is not doing anything wrong. She has just been operating on autopilot since day one and nobody ever looked under the hood. Question number 12. Jessica just selected S corporation. Does QBI apply on her situation? The answer is yes. And here's the nuances that most people missed. When you are an S corporation, you pay yourself a reasonable salary. The salary is in the form of a W-2 income. A W-2 income does not count as QBI. The distributions you are taking above the salary is what qualifies for the QBI. So the way you structure your compensation inside the S corporation directly affects how much qualified business income you have to deduct. Pay yourself unreasonably low and the IRS has a whole other problem with you. This is where the balance is needed. Congress intended the deduction to apply to the business profit, not labor. So Jessica's friend was right, but Jessica needs to understand why, because the implementation matters just as much as the election time. Question number 13. Rental property owners, do they qualify? The answer is no. Well, this has a layer. Rental income can qualify for QBI, but it is not automatic. The IRS wants to see that you are running it like a business, not just owning a property and collecting checks. There's a safe harbor rule that basically says if you're logging 250 hours or more a month in rental activity per month, then you've got a stronger case. Below that, it is just murky. And if you own one rental property and you barely touch it and hand it over to a property manager, that is going to be a harder argument. Congress designed QBI and rewarded active business participations. They weren't trying to give a windfall to passive investors who happen to own a piece of real estate. So the question isn't just to own a rental property. The question is how involved you are and can you document it? Question number 14. Someone missed the deduction for 3 years. Is that money gone? Well, not necessarily. You can go back and amend your taxes. Typically a 3-year window where you can go back and correct the return and claim the missing deductions you did not claim. Now it's not a simple process though. Now you are reopening your return and recalculating potential adjustments and other numbers. But I have seen business owners recapture thousands of dollars by going back and doing it. The bigger point is the cost to fix it is a fraction of what you left behind. People avoid amending return because they think it draws attention and it is too much trouble. And meanwhile, they are sitting on money that belonged to them. If you found out you overpaid your electric bill for 3 years, that is the exact same thing. Just one more zero. Question number 15. What is that one move that you can make today? First, have the conversation. That is it. Not next quarter, not when things are slow. Today. Book a call with a tax professional, your tax professional, and specifically ask them 3 things. Am I capturing QBI deduction? Am I structured to optimize it right? And am I approaching any threshold that I need to play around with? 3 questions. That's it. If they can answer all 3 questions clearly and confidently, you're in good hands. And if they look at you like you speak in a different language, that is also a very useful information. We offer a 30-minute consultation for free at D2 Tax. We don't pitch you, we don't pressure you, just clarify where you are, what you need, because the worst outcome here isn't paying taxes, it's overpaying them for years and never knowing about it. All right, rapid fire round, game changer. For the right business owners, this is one of the most valuable deductions in the tax code. Biggest myth, this is automatic. People think that if they qualify, it's just going to show up. It doesn't. You have to plan for it. DIY or hire someone. You can DIY a lot of things. The tax return, when real money is involved, is hire someone. You don't fly a plane for the first time you solo there. Deadline missed. Now what? Call someone today, not tomorrow. Every day you wait, it'll cost you. Any deduction can be fixed, but you have to acknowledge it first. Free consultation at D2Tax, what actually happens. Your numbers, your structure, and your picture. You leave knowing exactly where you stand. That's it. Look, I'm not here to tell you that you are doing everything wrong. Most of you are doing your best with the information that you have. But the QBI deduction exists. Bonus depreciation exists. And these are real tools small business owners are using right now to keep more of what they earn. Legally, ethically, and the right way. And if nobody ever walked you through this stuff in plain English, that is a problem, and I genuinely want to fix it. That is why we do this. If you want to know where you actually stand, link's going to be in the description for a 30-minute free consultation. We will talk about everything that you have questions, and we will decide which direction you want to go and whether or not you can go back to your accountant and they can fix it. And if not, then we are here to help. Hope that helps. Bye-bye.